C'est bon, hein? Okay. Okay. Okay, welcome to this first live. I'm very happy to be with you, and it seems to be that the whole world is with us. We have people from Australia, Hong Kong, Europe, and India and US, everywhere. So I know that for some people it's early in the morning, for some others it's very late in the evening. It's a little bit more than 7 a.m. Eastern time. It's 1 p.m. European time, and it's 8 p.m. Hong Kong time. So it's widespread. I'm very happy to be with you. I'm Mark Bertonesh, and we have met with a video, and I'm really happy to meet you live. We are going to spend an hour together. I'm sorry for these difficulties in getting in touch, but I am now in Sarasota, Florida for a board meeting, and we had some connection problem. I think everything is okay now, and I'd like just to very quickly present the objective of this live session, essentially three. The first one is to give a little bit of information about what's going on in the MOOC. The second one is to discuss the question that I asked you in the first video about the break-even point, and then obviously to spend as much time as possible on the questions that you have. So just one or two things. Remember that this MOOC is a teamwork, so you can always put some questions and on the chat and have some answers from anybody else. I think you learn also from the other participants. And just, but we'll be back maybe to that a little bit later on. Don't forget to go to the quiz. As you see now, what you have available every Friday is the courses video. You had the first one for this week. You'll receive the week 2 next Friday. You have one weekly quiz, and you have the PDF courses together with the case that we are going to have during the whole 4 weeks, the Gremlin case, and the weekly badges. And in week 5, you have new cases to assess your skills and try to obtain the attestation of success. So for the quiz, do them as soon as possible. You have until the end of the MOOC to do that, but don't wait too long so that they accumulated week after week. So I think now it's probably time to talk as quickly as possible of the question that I had asked you, and I had asked you to calculate the break-even point for Gremlin. I think the slide is going to show some of the results, which were quite easy. As you know, to calculate the break-even, you need 2 types of information. You need information on sales that you get from the P&L, from the profit and loss statement, and you need some information from cost accounting in order to be able to split between fixed cost and variable cost. And sometimes in real life, we don't have this information, so we cannot operate that type of analysis. In the exhibit 4 of the case, you add for the 3 years the split between fixed costs and variable cost. So sales, P&L statement, you see that on the slide now, 7,545,096, 9,995,000, etc. All the figures are in thousand, and you have the various costs in terms of fixed cost and variable cost. So if we do the analysis for 1986 very quickly, you see that in 1996, sales of 7,545 and a variable cost of 1172. So this is giving you a contribution margin, or a margin on variable cost, as we call it sometimes, of 6,373. And if now you say 6,373 divided by the sales of 7,545, you get the contribution margin, which is 84.5% for 96. So what does it mean? It means that anytime I'm selling one, I'm generating 84.5 cents to cover my fixed cost. And because my fixed costs are 4,500, it is not difficult to say that if I have to cover 4,500, 400, 500,000, because all the figures again are in thousands, 4,500 divided by 0.83845, 84.5%, this is giving me the break-even point of 5,300 roughly. So it means that in 1986, the break-even point was 5,300,000 euros. If you do the same thing in 97, without going into detail, again, you have your sales, you have your variable cost, you can generate the margin, and if you do that calculation, you'll find that the contribution margin is 83%, 83.2 exactly. And by taking the fixed cost of 6,081 that you divide by 83.2%, this is coming to the screen now with a slide, you get a break-even point of exactly 7,309. And finally, same calculation for 98, with the sales of 17,738, variable cost of 3,615, and therefore you can calculate the contribution margin of 79.6%, and by dividing your fixed cost of 11,361 divided by 79.6%, you find the 14,272 of break-even point for 1998. So these are the answers. I think what is interesting to look, when you look at this figure, what is it telling us? What it's telling us is to see that what this break-even point represent of my sales, its common ratio is to look at sales divided by the break-even point. 1986, 7,545 divided by 5,327, and this is giving you 142%. What does it mean? It means that your sales represent 142% of your break-even. You are 42% above your break-even point. If you do the same calculation in 97, without going into detail, sales over break-even point, you find that you are at 137%. Now you are 37% above your break-even point, and in 98, you find 124%, so you are 24% above your break-even point. Is that a problem? Not really. I mean, as long as you are, and most companies will say above 20% of your break-even, you are in a rather safe place, but the trend is not too good, and we are getting closer to our break-even point, and if things continue like that, it might be a point where we are going to get from a profit situation to maybe a loss situation. But there is nothing wrong at that stage. What is interesting to look at, and maybe some of you have looked at, and we mentioned that in the video, is to look at how the costs are moving through time. And you see that the cost of sales, the cost of producing and selling the product are going up tremendously, from 43% in 1986 to 54% in 1998. This is reflecting the fact that the product are becoming more and more complex, that they are integrating more and more items, more and more sophistication, and that the company has not the ability or the strength or the power to include this increased cost in its pricing. So therefore, the weight, the importance of the cost of sales, the cost of producing what I'm selling is getting bigger. Another worrying things, as you have said and as you have seen in the case, is the fact that the cost of distribution and the marketing costs are going up too. If you do the calculation, they are going from 11% of sales in 1986 to 14% in 1988, which is reflecting the fact that Gremlin is becoming global, that they have more distribution costs. They're not just distributing in England or in the UK, but all over the world. And therefore, they have increased cost. The only good news is the fact that the administrative costs are slightly going down. They go from 22% of sales in 1986 to 16% in 1988. So there is some kind of economies of scales in that respect, and the company is able to reduce its cost of administration. So that's, I think, what was necessary to say for this assignment that I asked you to look at about break-even. I think linked with that now, I think it's time probably to open the discussion, because that's what live discussion is all about. And I am looking for your question, not only on this element of break-even point, but on the whole week and on the whole topic of the week, which is margin analysis. I'm looking at the question now. So can we get these slides off so that I can see the questions? First, so at that stage, well, the question is, can we make a conclusion of Gremlin? At that stage, it's too early to make a full conclusion of Gremlin. We need to look at what we are going to see in week 2 and week 3 and week 4 in terms of investment, in terms of financing, in terms of profitability, to have a complete diagnosis of the company. But what we can say is that the situation in terms of break-even is not too bad. The trend is a bit worrying. The cost structure is raising a few issues in terms of the ability of the company to put the complexity of the product and the increased selling costs into its pricing. And therefore, we have to keep that in mind for the future week and for the full diagnosis of the company. Okay. Questions? there is some eco problem, some people say. In 1988, marketing expense increased nearly 2 times more than other costs. How can you justify companies saying close to break-even point? As I said earlier, and I'm sorry to repeat, but the marketing cost essentially increased because the company is going from a local situation to a global situation. And therefore, in terms of marketing and distribution, because the two costs are put together, there is an increased need for marketing and distribution as the company is selling the product everywhere in the world and not just in England. So the increase that we mentioned from 11 to 14% for the selling cost as a percentage of sales is unfortunately something that the company has to support if the company wants to become more global. And the consequence of that, of course, is that some increased fixed cost is leading the company to be a little bit closer to its break-even point. But as we said, we are not in a situation which is, for the moment, in 1988 at least, worrying at that stage. We are going to see that there are some more heavy questions in terms of financing, in terms of net working capital in the following of the MOOC. But this is something to keep in mind, that the company is having its sales growing at a rate which is not as fast as the increase in cost, and that there is some kind of a scissor effect, as we have mentioned it in the video. How can we look at the break-even of a trading business which has very less fixed cost, buying from Gulf and selling in India? Yes, I think the trading business is a good example. I think we mentioned that in the video too, of a business with very little fixed cost, and therefore in that case, I mean, the break-even is rather easy to reach because the fixed costs are very small. But the counterpart of that, I mean, fixed costs are something that we like when we grow, at least in a certain limit, because they don't change, as the name is saying, and therefore they create the economies of scales, and they make the company possible to do more with the same amount of cost. While for a trading company, the more you grow, the more your variable costs are growing, and therefore the margins remain the same, assuming that your variable costs are not increasing at a higher rate than your sales. But for that respect, it is true that the trading company and any company in general which has low fixed cost is getting a break even faster. Do we have to use number of goods sold? No, we don't have for break-even analysis. In the case here, we don't have the number of items that we sold. We just have the value of what is sold. So we have calculated the break-even in euros, in values, and not in units, because we don't know the units, and probably the units are quite different with very different prices and maybe different variable costs. So we should, if we had the information, we could do a unit break-even analysis on every product or every different product that the company is selling. Does the contribution margin remain constant for different level of activity? The answer is no. I mean, there is no reason that the contribution margin remain constant. And as a matter of fact, in the case, if you remember the figure, the contribution margin went slightly down, because the contribution margin was 84.5% in 1996 and went down to a little bit less than 80% in 1998. So the contribution margin would remain constant if your variable cost would increase at the same rate than your sales. But in the variable costs, you have cost of raw materials, cost of labor, and a certain number of things which might increase at a different rate than the rate of your sales. So there is no reason that the contribution margin would remain constant at different level of activity. How far do we need data to get a simple break-even analysis? Does it have to be yearly historical? As I said earlier, in order to do this break-even analysis, and I can tell you that in most real case, when you have the information of a company through public information, you are not going to have the split between fixed cost and variable cost. So therefore, it's quite difficult to do a break-even analysis in that case. In the situation of Gremlin, we have it, so we can do it. Sometimes what we do is we make some assumptions about the part in that type of business that represent fixed cost and the part that represent variable cost, so we can have some kind of a rough idea of what is the break-even point. Doing an historical analysis when you have it, when you have the information, is always something very interesting because it's a way to see how the company move vis-a-vis its break-even point. Is the company moving towards its level of activity being closer to its break-even, or on the contrary, is the company getting further away from its break-even point? This is information, in particular in period of uncertainty and in period of volatility, which is kind of important to have. Is it true that the ideal company would have managed to make all fixed costs variable? This is an excellent question, and this is what every manager is trying to do, is to transform some fixed costs into variable costs. And when you look at some policy and some strategy of outsourcing or things like that, this is obviously what it's trying to do. The problem of fixed costs is that we love them in terms of expansion, because as I said, I mean, you do more with the same level of cost, at least within a certain limit, in certain range, because after that, the fixed costs are going to move by step. The problem is that when we get to a recession, when we get to a tough economic condition, the fixed costs become very difficult and very heavy. And that's where we try to transform them into variable costs, or at least semi-variable cost. That's the asymmetry about this fixed cost issue. Of course, one of the attempts of many companies is to try to make sure that the part of the fixed cost is not too heavy in case there is some economic downturn. Will we see multiples and WACC? Not in this MOOC, because this MOOC is really devoted to the financial analysis. Multiples are essentially, as you know, methods to value companies, and there will be probably another MOOC in the future on valuation of company, where we are going to discuss about discounted cash flow and multiples, and the main multiples used in practice. But in order to do so, I think we need to understand very well the basic elements and concept to do these multiples. For example, one of the very common multiple used in practice is EV over EBITDA, enterprise value over EBITDA, earnings before interest, tax, depreciation, amortization. In order to understand it, you have to understand EBITDA, which is one of the things that you have seen in this first week. And the same when we talk about price earning ratio, or the same when we talk about EV over revenues, etc. So the multiples are, we're going to cover them in probably another video, but this video is assessing the basis to understand really what they are. The WACC, we are going to mention it very quickly in the week 3 and 4, I think roughly what it is without going into detail. We'll mention how we very briefly calculate it, but we're not going to go into details of talking about how do we value the cost of equity and the risk premium and things like that, which again will be covered probably in another MOOC on valuation later on. Can operating leverage also be described as the extent to which a company fixed costs are used to full capacity? Yes. I mean, operating leverage, by opposition to financial leverage, we'll talk about it in the following weeks, which is the proportion of debt and equity and how this is creating volatility of the earnings of the company. Operating leverage is resulting from the split between fixed cost and variable cost and creating some kind of operating risk of the company by opposition to the financial risk. So when we talk about this fixed cost used at full capacity or and needed to be we need to reinvest to go to the next step, this is operating leverage. And I think in the video, if memory is good, we use on some occasion the expression operating leverage as a substitute to the classification of fixed cost, variable cost. The higher your fixed cost, the more your operating leverage, the higher your operating leverage. General comment about the course. Let me see what I notice. A big difference in complexity between the videos and the course material chapters. There is also a lot more information in chapters. What level of understanding and complexity should students aim for? The course material is really reflecting what we do in the videos. So personally, I don't see any difference in complexity. Maybe what's happening is that a video is probably going a little bit faster, so it gives the impression of being a little bit more complex, while when you read something, you can come back very quickly to the line before, and it's sometimes easier to understand. We have tried to make the videos, each videos not too long, because there is a probe of attention, and after a few minutes, people cannot follow it anymore. So I think also that the videos should be, and it depends also of the time that you have, but should be looked at several times. I mean, looking at the video once, you are not going to catch everything, and probably like you reread an article, you have to review probably several times the videos, and they will look maybe a little bit less complex than the first reading. Laurence, I would assume a service company costs are mostly fixed. Yes, in general, when you look at that, I mean, service company is essentially a company which is hiring and using people and a little bit of computers and things like that. The old question that your comment is raising, which I think is a very important question, is labor cost, variable cost or fixed cost. Traditionally, in all the analysis, we always see variable cost in the labor cost in the variable cost. A lot of people today, and in many countries, will consider that labor costs are mostly fixed costs because it is difficult to adjust this cost in terms of the volume of activity. And we know that in some countries it's almost quite impossible. So the answer to your question is yes. Most of the costs in that case, if we look at material like computers and things like that, which are mostly depreciation, fixed costs, and labor costs, if you consider them as mostly labor cost, fixed cost, which again can move by step. When activity is doing better, you hire people. If the activity is going down, you lay off some people. But it is very difficult to consider them as purely variable cost. I have heard that hotel industries would like to spend high fixed costs to generate high operating leverage. Does it also apply to other business sectors? You know, I have been on the board of an hotel company for long years. I've been on the board of a company at that time called Radisson SAS Hotel, which has become Radisson Blue. I think one of the trends in this industry has been to try to reduce part of the fixed cost and essentially the amount of capital employed that we are going to discuss in the second week by selling the properties and keeping the management contract. And by saying what is our business, which business are we in? We are in the business of hotel and not in the business of real estate. And by doing that, they have gone from a strategy where most of them own, a long time ago, their hotels, to a strategy where they just have a management contract, which is more a service business, and as such is of course quite high in fixed cost. But the big difference is more, I think, if you talk about the industry in terms of cap employed, by trying to reduce the cap employed and trying to reduce the high investment in buildings and land. Another question, maybe? Wouldn't a manufacturing organization have more variable cost instead? Yes, in general, of course, a manufacturing company, and again, you'll have to look at which kind of company we are talking at, but a manufacturing company would have higher variable cost. I mean, if you look at the gross margin of various industries, in general, the manufacturing companies have lower gross margin because they have higher variable cost than some other service business or knowledge companies and things like that. So yes, but again, you have to look at differences between, for example, the pharmaceutical business and I don't know, the car business or the steel business, where the structure of cost might be slightly different. How do one calculate the break-even on purely service companies? I mean, the same way that you have calculated before. I mean, if you always do the same. You look at your sales, you deduct your variable cost, if any, and you get your contribution margin, and you calculate your contribution margin in percentage, and you compare that with your fixed cost. The problem is that if you don't have any variable cost or very small variable cost, your break-even is very low, because your contribution margin is close to 100%. So the higher your contribution margin, the better you are in terms of reaching your break-even point. Which are the standard company reports where you would find this number? From the balance sheet on the income statement? You mean these numbers of fixed cost and variable cost, I guess? And the answer is nowhere, in fact. I mean, the split between fixed cost and variable cost is information coming from cost accounting. And the balance sheet and the income statement are the basis of what we call financial accounting. Companies publish their financial statements, and that's what we use to analyze them. They, in general, don't publish, because they don't have to, and they don't want to sometimes, publish cost accounting information. So if you don't have that, and from an external viewpoint, very often you will not have it. If you have some, if you're a financial analyst and you can interview management and get some more information than the one which is published in the annual report, you can get some information on some idea on the split between fixed cost and variable cost. But in general, you will not get this information. given that trends are very important in making sense of the analysis in real case, how easy is to make comparison with other companies, particular at the country level, when they are exposed to different underlying foreign exchange exposure? Wow, this is a question which is a little bit going much above what we are covering so far in the MOOC. The question of comparisons of companies is always a big difficulty, is a big problem, because you have to make sure that companies are in the same businesses, and companies are diversified sometimes in various activities. So if you want to compare companies, you have to compare what we call pure plays, either company being in the same business or a company which have the same type of diversification. Now, the additional difficulty that you mentioned is that if you compare a company in Japan and a company in the US or in China, whatever, you have a different foreign exchange exposure. We probably have also another MOOC one day on risk and risk management, and in particular foreign exchange risk, whether it is a transaction risk or a translation risk. You have to make some assumption about the way the foreign exchange are going to move. You can use, but I don't want to enter in detail at that stage, forward rates as a good proxy, but it is not an easy way to do when foreign exchange are varying in very different ways. You mentioned the example of pharma industries in terms of slightly different cost structure. Would you elaborate on that, please, Thibault? Yes, what I meant is that if you look at a typical P&L of a pharmaceutical business, you will find that the gross margin is big. Why? Because the sales are important, and the cost of producing these pills or this medicine or whatever is rather low. So the gross margin is very high. Now, below that, to get to the operating profit, the EBIT, you have very heavy R&D. I mean, typically, pharmaceutical companies spend between 15 and 20%, to be broad, percent of their sales in R&D, which is huge, and huge selling expenses. You know, because to induce doctors to use these medicines, I mean, you have a lot of marketing expense, distribution expense, typically, and I'm giving a very gross structure, but you'll have a company with 100 of sales, you have probably, let's say, 15 of cost of sales, producing these things, these medicines, so it's giving you 85 of gross margin, and then below that, you have probably, let's say, 15% of R&D to be on the low side of the range, and 35% of marketing and expenses, which turns out to give you 50%, and therefore you are left with an EBIT of 85 minus 50, 35. So what I mean is that very few companies are spending as much as the pharmaceutical business in terms of R&D, and very few industries are spending as much, even if things are changing today with a lot of technological change, spending as much in terms of the selling expenses. And the way you could, as you know, get high sales and be able to cover all these costs, in particular R&D and selling expenses, is because you are protected in most countries by patent, which can last between 12 to 15 or 17 years, which gives you a kind of monopoly. And one of the problem of the pharmaceutical business today, but I think it's beyond the scope of this slide, is to face the fact that some of these good products are losing their patent rights, and that generics are coming, and generics are pushing the price down because they don't have to cover the cost of R&D, they don't have to cover high marketing costs, and therefore they can afford to be sold at a much lower price. And that's one of the big challenges of the pharmaceutical company today. In a manufacturing company, is depreciation a production of production equipment a fixed or a variable cost? and equipment that is used more, higher sales level, will reach its end of life faster. Therefore, it is viable. This is an interesting and difficult question, because when you talk about depreciation, are you talking about the fiscal depreciation, the tax depreciation, or are you talking about the economic depreciation? The economic depreciation is exactly what you say, which is that you think that the equipment is going to last 5 years and you decide to depreciate it in 5 years. But if the taxman is telling you that this equipment should be depreciated on 8 years, whether you like it or not, for your tax reporting, you'll have to depreciate it on 8 years. And therefore, the cash flow impact of the depreciation is the tax impact. You could always depreciate it in 5 years, but the part between the 5 and the 8 years is not going to be recognized as a tax deduction. So we consider depreciation as a fixed cost, because what is important is really the tax depreciation, the one which is going to have an impact on your cash flow. We'll come back to that later on in the MOOC. So even if what you say is right in terms of economic depreciation, real, the real impact of time on the equipment, the fact that you depreciate on the tax basis a certain amount show that this is a fixed cost. Now, again, we are all coming from different countries. In most countries, as you know, companies will provide two sets of accounts, one using the tax rules, and in particular for depreciation, and one using a kind of economic approach, using economic depreciation. What is the best approach to distinguish between fixed and variable costs from an internal position? Again, this is not an easy question. It's easy on the blackboard to say. In reality, it's always raising question. Variable cost is a cost which varies more or less proportionately with the level of activity, the sales. Fixed costs are costs which are fixed, at least in a certain range. As we say in the case, you produce 100, you need so much raw materials. You produce 110, you need 10% more of raw materials. But you still have one accountant, you still have the same number of computers or whatever. So now you go from 100 to 300, and obviously not only your variable costs are going to increase, but your fixed costs are also going to increase, because you will need probably more people in the accounting department, you need probably more computers. So you'll have a step. And the question that to distinguish is, what are the costs which varies, let's say, I don't like the word, I'm going to use it for a minute, regularly with the activity, and the costs which are varying by step, which mean that they are remaining fixed, constant, if you prefer, in a certain range. And I think this is the only approach to distinguish between these various costs. Is financial analysis the same for all countries? Yes. Yes, in terms of the methodology, in terms of what we stress in this MOOC, what you try to find. I mean, it is an overall thought process which I really believe, and I've been exposed and teaching and consulting in very, very different countries in the world, is the same. Now, the raw material that you use for that might vary in terms of quantity and quality from one country to the others. There are some countries where the financial information is very widespread, of very good quality, for historical reasons, for legal reasons, for whatever reason. And there are some other countries where the information is not so wide on the quantitative basis and not so good on the qualitative basis. So the answer to your question is yes, the principle of financial analysis are true all over the world. Companies should generate margin. Companies should get a good return capital employed. We discussed that. Companies should manage its cash. Companies should have a strong balance sheet. Companies should not have too much debt. All of these things are true all over the world, but of course you have to adapt that to the environment, and in particular the quality or the type of information that that you have available for you. Liz, will you go through the other financial report for Gremlin, i.e., item the cash flow statement, income statement, balance sheet? Yes, yes. You know, I just want to remind you that Gremlin is going to be with us for the 4 weeks of the MOOC. So we just look at one small aspect today, which is this break-even analysis, but we are going to look at the cash flow statement, the balance sheet. We are going to look at the solvency. We are going to look at profitability of Gremlin. So Gremlin is going to follow us, and to make sure that the learning process is going well, you have another case in week 5, which is not compulsory, which is an option, but where you are going to go through again the whole methodology and the whole process of making the financial analysis. So yes, we'll come back to Gremlin. How about a company that outsources versus maybe a company that is vertically integrated? The analysis within the industry sector will not be the same. Yes, of course. I mean, and it is a cost-benefit analysis in that case. I mean, outsourcing, and you know that for most of you, has some good advantage in terms of cost structure in particular. It has some drawback in terms of safety, in terms of strategic strength of the company, and the choice is a balance between the two. But obviously, if you look at two companies, even in the same industries, which have a different profile, one using a lot of outsourcing, the other one being, as you said, vertically integrated, we are going to have different outcomes. Now, this doesn't mean that it is meaningless to do it, because it is a way to show that some ratios will improve if you outsource or not, some ratio will deteriorate. And as I said earlier, the whole idea then is to look at this cost benefit. Are the negative points higher than the positive points, or vice versa? So this is what you have to look. But you're perfectly right to say that this is an additional difficulty, that even if you're in the same industries, you may have a different model, and you may have different business model. I remember making a comparison some time ago between two sellers of books. At the time they were only selling books, which was Amazon.com and the American company that I forgot the name, Barnes and Nobles. I mean, these two companies were in the same business, but with a very different approach. One was really an internet company. The other one was a traditional distribution company. And obviously, you look at a certain number of measures, net working capital, investment in fixed capital, capital employed, return, etc. They are very different. But I think it's an interesting lesson to look at the differences between these two approaches. I think said the time is running. Some of you have to go to work. Some others have to go to bed. This is United Nations. This live. I mean, you have the whole world here. So probably it's time to conclude and have a little conclusion of that. The two things I would like to say is that first, I'd like to thank you very much for your participation. I'd like to thank you for your very good questions, very relevant questions, and I'm sorry that I had no time to answer to all of them. Remember that you can continue to post this question and to chat with some of your colleagues, which might be in some of this industry that you have mentioned, and answer your question. It's a teamwork. I think we have looked at a small part of Gremlin, and again, we are going to come back to some other part of it in the future, in terms of capital employed, in terms of balance sheet, etc. And so far, we have said that Gremlin, from our approach, as a trend which is not optimal. We are getting closer, even if we are still above, well above our break-even point. That you have some concern about the cost structure, that in particular, the cost of producing and the cost of selling these products are going faster than the level of growth. And this is a concern. This is a part of the scissor that you're mentioning in the video of week 1, 2. But we need more information to complete the diagnosis. I would like to make sure that we meet next time. Remember that these live sessions are not just on the exercise that I'm giving you. I mean, and some questions show that. So it's not just on break-even this time or on the question that we'll have in week 2, but on the whole week. So whatever concern you have, whatever question you have, we can discuss that in the time that we have. Next time, I will be hopefully in Paris, so this probably connection will be easier, I hope. And but this time it seems to have worked pretty well. I wish you a very good continuation. Keep going. Keep practicing with, of course, Gremlin. Keep practicing outside. I mean, start to look at some of the P&L and break-even and balance sheet, I'm sorry, of company that you can find on the net, and try to apply that to apply the starting tools that you are developing in this MOOC. As I said several times in the video, practice is important. This is the only way to improve, as I said, like tennis and golf. So do that, and I'll be very happy to see you again. Make sure that you keep going. Don't be discouraged at the first week. Keep going. I think it's a learning experience, and you are going to learn progressively. Nobody learns the first time everything. We have to be patient, and you have to invest sometimes. And I hope that we will do this trip together until week 4 and hopefully week 5. And I look forward to seeing you next week. So thank you very much for waking up very early for some of you, and for working very late for some others, and for missing lunch for the third part. It has been a pleasure, and I look forward to seeing you very soon. Thank you very much. Thank you.